Yeah, hello. Good day, good morning. Yeah, it's um is a is a there's a VIX 75, and this strategy can be used to trade any market, but I'm using it to analyze the VIX 70 volatility VIX 75 from binary. Okay, so let's start. If you've been wondering how to trade the volatility VIX 75, is you can trade it without indicators, but I like to use the 50 moving average and the 100 moving average just to keep track of the direction. Okay, so let's go to the daily time frame. Okay, so this is the daily time frame. As we can see, VIX 75 has been buying, it's been bullish all through. Okay, so this is how you analyze the VIX 75. Without the indicators. Okay, so without indicators, we use price action and we use trend lines. So I'll take my trend line and I draw it from where it's visible. It's visibly touched. It's visibly touched this zone, this zone, this zone, and finally this zone. Okay, so if we extend the trend line, realize that it also touched that zone, but okay, it touched this whole zone. Okay, so we take another trend line and then we draw it on the upside. What do we realize? A trend line is valid when it touches two zones or two turning points. So that will be our equidistant trend line. We can draw another trend line in the middle because visibly we can see it touched this zone, this, it broke out of it here. As you can see, it came back. So this zone structure, this whole area structure is something that we can see as a head and shoulder. This is what we call the head and shoulder. So it's something that we can visibly see as a head. This is the head, shoulder, another shoulder. It comes in and forms another shoulder. So this is something that we can respect as a head and shoulder if we were using those patterns. Yeah. Okay, in this area, we can see the price had been trying to break below or above, so it was ranging. And visibly, we can see the price does a candle chart, the candlestick chart, that's another head. So this is what we will call the head and shoulder, and this will be an inverse of the head and shoulder. So if we take our rectangle, we can see even though we marked this area as a zone that's attached, it also respected that pattern of a head and shoulder. So this is the shoulder, head, shoulder, inverse. This is the body. So to trade something like this, we can take our trend line and mark the area. So if we see a break above the area and any indication that is going up, we can then use that, okay, to take it to this trend line. In this case, it broke above the trend line and went all the way to make a higher high. Okay, so this is another way to trade. This is the way I trade the volatility VEX 75. Here, we draw another trend line here. It's not very visible here, but we can see the price rejecting from the trend line. We can take our trend line and draw another trend line from this top across the bottom. As we can see, price here respected this trend line. From this point, we'll not know what to do, but at least there's another way you can measure where a trend will end. So sometimes you can use the Fibonacci. So the VIX 75 respects the Fibonacci, it respects trend lines, and it respects moving averages. So after all this, I'll turn on the moving averages so that you know where the direction is and why you could be and how you could be taking advantage of some of the price action. So as we can see, it did a double top and then it hits the trend line again at this point. So at this point, possibly you'll be looking at this as a bullish flag or something like that in the daily time frame. Okay, so then it comes down to break that trend line all the way down. So from here we can see that, okay, on the daily time frame, this is where the direction is going down. It goes all the way down and then comes up. So this is the first touch of two places. Touch. Okay, so it touched it twice. So one, this could be seen as some form of a touch because, yeah. Okay, so if we draw as well, you can see it touched the trend line here in this zone and in this zone. So this is a valid place to be considering a trade. But let's say we didn't take a trade here. We wait, it touched this point, it comes back again to that trend, and then that's a price action. We can take this trade all the way back to this inclination. And then we can take another trade from here down. We take another trade from here up. And in this case, it broke out of the trend, which in this case is a bullish wedge or a wedge. Okay, so it hits the top, hits the top, hits the top, then it breaks out of the wedge. At this moment, we will be considering taking trades up because the whole structure of the volatility VIX is a bullish structure. So we'll consider taking trades up. So from here, we can draw another trend line from the bottom. Yeah. And then and then consider trades that touch that trend line. I'm doing all these analysis on the daily time frame. If we switch down to the 4 hour time frame, we'll see a different structure, which can give us even more entries. But okay, on the daily, we see one touch here. This, and then that we see another trend line coming from here. And that trend line was respected 1, 2, 3, 4. And as I said, it broke out of a wedge, or it broke out of the structure. So it's now bullish in this area. So we'll be looking at trades from here as bullish. After it comes back to test the trend line, we can take a buy. So if it comes back again and comes back again to the trend line has been tested twice. So the third time, we can take another trade. Fourth time, we can take another trade. This is even a convincing trade because this is a bullish engulfing, and it gives us indication the market is going up. And it goes up all the way, and we can take profits from the previous high up here. So after it gets to this previous high, it breaks again, comes back to retest, price action, engulfing. We can take this trade up. It comes back again, take this trade up. Comes back again, take this trade up. And this time, it goes all the way up. But before that, let's see what structure it gave here. This is also a bullish structure. After it breaks out of this structure, it starts testing the trend line, trying to break below. It couldn't break below the whole daily structure here, the daily trend line from the bottom. It couldn't break below. So what happens? There's a push up. Before that push up, there was another structure like this, another bullish flag. This is a bullish flag. So as it breaks into that flag and starts consolidating, we wait for a breakout, and there was a breakout here. So after the breakout here, there's a pullback to test the structure. So after the pullback, we can take a trade based on the price action. This is a pin bar. So we have two pin bars and a double bottom. It's not so clear, but with a bit of experience in trading, you will understand that this structure is a bullish structure. If we switch to the 4 hour, it tells us how the double bottom was formed. Okay, so we are in 4 hour time frame, and this is the area we're looking at. So after I broke out of the structure, you could see there's a pullback to the structure and to another trend line, and then it breaks out again. This is a visible trend line from the top of the 4 hour time. The top here, you can see after the breakout, it pulls back to that trend line, and then there's a price action inside bar and some kind of a second candle that shows an upward move or indication to move up. So here you can take your trade up, take your profits either here, here, or here. You can even take your profits here based on, but this is also an indication it will continue. So this structure is a continuation pattern. So this is also a continuation pattern. Okay, so once it does this double top, you know the market is exhausted. So there's a possible bearish move. So from here, you could get out. Okay, so after it comes down to this point, there's a indication it will go up. So it tries to do a double bottom in the lower time frame. So it succeeds finally with a double bottom and then engulfing on the trend line from the daily, on the trend line from the daily time frame. So it goes all the way up here. And here, once again, you can see a double top. So this is an indication of the price being exhausted. It's gone far away. So here, from here, you can be taking profit from your buy, and then you can be exiting the trade and maybe possibly looking at possible sell opportunities. So here you can see the market move down, up. Once it comes up here and gives you this double top indication, you can take it down. So this is another way, this is a way you can analyze the volatility VIX 75. You can draw another trend line from this top and then from the bottom to form an equidistant channel. And here is a live trade. The channel is broken. So what does it indicate? It indicates that this could go, it indicates that this could go up. It indicates that this could go up here. Yeah, it's an indication the market could move up here. So let's see, possibly a pullback to the structure, or possibly another structure that will tell us, okay, this is going to move up. So you take your trend line and see if you get some rejection on the trend line for a good risk to reward. So possible rejection on this trend line. There's not a major trend, it's just a breakout. So we're just seeing a possible move to this trend line so that we can take our trade up. And then our stop loss will be under this price action. So our stop loss can be here. So let's measure. There's a long position. So we can measure from here. Possibly this will move back here. So let's say the trade moves, the price moves back down here. You can measure from here. You can measure from here. Wait a minute. Okay, so we can measure from here and take it up all the way to the trend line up here. Possibly we could take our profit somewhere here. Okay, and then our stop loss is down here. So let's see if it gives us a good risk to reward. Yeah, let's see if it gives us a good risk to reward. Okay, so here we can see we are risking 3.7% to make 6%. That's about 1:2. Yeah, that's about 1:2. So if our stop loss is somewhere here, yeah, so if our stop loss is somewhere here, yeah, we can put our stop loss up here. Then we get something about 1:3 risk reward. risk to reward will be 1:3. So if you do your calculation, it's all about calculation. You're calculating what risk you are risking, calculating the risk that you're taking, and seeing if the risk is worth the reward. And if, in case your stop loss is touched, you'll not be kicked out of the trade for a long time, because you have to risk reasonably. You always have to take about 1% to 5% risk, maximum 10% of your trading capital. So you don't risk more than that. That's the way to succeed in volatility VIX. If you don't want to always be funding your account, you risk low and then you gain high. That way, you can make more money in the long run. This trading strategy is perfect for volatility VIX 75, volatility VIX 10, volatility VIX 25, volatility VIX 100, volatility VIX 50. You can use the same strategy for all these volatility VIX index markets. You can use it for all these I don't know if I should say pairs, but you can use that for those assets and it will work very well. Share, comment, leave some feedback, and subscribe.